Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Finally, it's a Friday. Finally, it's the last trading session for 2023. But we are, as always, coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Reema. Guys, hi. Good morning.
Good morning, guys.
Good morning. Final day of the week, the month and the year for trading.
Do you guys get nostalgic? I do. Just thinking the year's gone by and it's been a good one and all of that. I'm already in nostalgic mood. Just putting out an FYI.
So that means that you actually reminisce and you think about what's happened during 2023?
But it's been a big year for you,
But
right?
it's been a good year, so I'm not complaining.
What happened last week. Anyway, it's actually been a good year to look back at, right? You just have to, from a financial point of view, you just have to look at the portfolios. I'm assuming that for all of you, for all our viewers, it's been a fantastic year. Markets have done so well, so no reason why you should have done any worse as well. We'll get to that in just a bit, but let's just address the here and now in terms of how the market is looking, because the rally has been non-stop. This week, for example, the Nifty is up 2%, another 2%, I should say, rather. And this, of course, after the previous week when that Wednesday the market sold off pretty sharply. So that's the backdrop. Now, U.S. markets had a quiet session overnight. The S&P 500 was absolutely flattish. Nasdaq was down about 0.03% or so. So nothing at all from U.S. indices to take off. I mean, we would have liked that the last day the S&P hits a new record, and that's behind us, that's in the bag. But we'll have to, I guess, wait for US. By the way, of course, has two more sessions to go before they call it a day. You get the 10-year yield, which actually went up about 5 basis points. So the 10-year is back at about 3.84, but the far cry from the 5% levels in October, right? So there was an auction. The U.S. Treasury, the U.S. government sold about $40 billion of 7-year notes, and there was pretty poor demand for that, and that's the reason why yields went up. By the way, January in the U.S., it's going to be a pretty heavy month in terms of Treasury supply, government raising money by selling bonds. So we'll see how that goes. I think about $200 billion in the month of January, almost $200 billion. A dollar index that went up a little bit, about 0.25% or so. We are back above the 101 levels. Oil prices, they were down 1.6%, and we are just over the $77 per barrel mark. I mean, basically, it's been 76, 77 to about 80, 81, but no real indication of where things want to go in a definite kind of way. Now, just to circle back to the market here, we've been working with extension of the Fibonacci retracement levels, and the next targets for the Nifty are 21,830. We're almost there. So then, we're introducing one more, which is actually, the 161.8% retracement is not 22,000, it's pretty close by. So I just rounded it off. So, logically, the 22,000 level is the next kind of number which the Nifty will sort of look to scale. There is a technical significance there as well, as I said. And on the downside, the 40 hourly exponential is around the 21,500. So I guess that could be used as a bit of a trailing stop. But with these big moves that we've seen every day, the distance increases between where the market left off the previous day and where it leaves off the next day. So supports kind of fall behind, but that's the one that is important. On the Nifty Bank, similar technical levels, 49,175 and 49,600 are the levels for the Nifty Bank to look up to. And, one could use the 48,000 level as a support, as a trailing support on the downside. That's, very, very close by, about a 1% odd downside from where we are. Now, markets have done very well. I just want to leave off with one point, because we're wrapping up December, we're wrapping up 2023, and we're looking into January. If you are trading, and only if you are trading, and you're trading long and you're enjoying this momentum, etc., especially if you're enjoying this momentum, remember the January seasonality effect. 12 out of 16 years, January has delivered a negative sort of return. The 4 years when January was positive was because, the previous year or the last couple of months, that is November and December coming into those Januaries, was very poor, was very bad. So remember that. And this has, of course, been an exceptional year. 2023, the Nifty, the mid-cap index, for example, is up 5% this month, in the month of December. So remember that, especially if you're trading and have been enjoying the momentum. I think one needs to be mindful that maybe there is a bit of a break coming. It's possible that this is another positive January, but I think it's important to be mindful that seasonality is not in your favor. And of course, just want to wrap up with 2023. Nifty 20, small cap 55, mid cap 45, Nifty Bank only 13, and that's the reason why there is so much consensus bullishness now that banks are the next place to be, which offer comfort, etc. But I think there should be nothing but gratitude for the big returns we've seen in 2023. I don't think anybody saw it coming, especially with what's happened with mid caps and small caps. Guys.
Just to add to that point about January seasonality, the last 5 Januaries, markets have given you a negative return. In January of 2023, the Nifty sensex was down 2.3%. The January before that, it was flat, but minus 0.1%. Before that, minus 2.5%, minus 1.7%, minus 0.3%. So the last 5 Januaries have been negative. If you want to go back to a positive January, you have to go back to January of 2018.
It's like the hangover after the party, right? That's what Jan ends up being. I guess that's what data that you guys are talking about. That's what it is throwing up. Speaking of, data, I guess the biggest surprise of 2023 as the year winds up is this rise both in FII participation, the net buying that's come in, and volumes. And I just want to put yesterday's number up on the board. 4,359 thereabouts. I mean, that is what we got yesterday. Remember, the day before, the number was almost 3,000 crores. Yesterday, we were talking 4,300 crores. And these are surprisingly high numbers for the end of the year. And they're backed by a rise in cash market volumes. Yesterday's turnover was higher than the previous session as well. And we did about 1,25,000 crores. Nothing to sort of ignore or take lightly there. Those are very decent volume numbers that we've got going. Of course, we've been asking guests about this as well. And, one thought process is that a lot of this is ETF buying. And, the program trades that are playing out with India perhaps getting a fair share of allocation as NAVs are managed, as, final portfolios are managed before the 31st of December. Perhaps that explains the kind of sudden gush of liquidity that we've got at the end of the year. But anyway, I'm sure people are not complaining. Bulls are quite happy with that. Another positive cue, by the way, in terms of the last 24-hour action is the fall in oil prices. Brent was down almost 3% overnight. And this is because of, 2 factors. One, of course, that there is easing tension around the Suez. Maersk has been talking about getting more and more of their ships to go through the Red Sea passage. So are some of the other shipping lines in Europe. So that's working out well. And by the way, the buildup in U.S. crude stockpiles, or rather the drawdown, I should say, was far greater than anticipated. The drawdown was over 7 million barrels. The expected fall was less than 3 million barrels. So there's a lot of oil consumption in the U.S. market. So basic demand supply plus easing of all the concern in the Suez, that seems to be helping. And oil was down. We're down to about 77 now on Brent. So that's another positive cue for today. But guys, I don't know. The hope would be that we end with that little bit of a green tinge as it has been such a great year. But then who knows? We've had a great week as well. So maybe some profit booking sets in. I just want to end with the tally of the year. The U.S. market itself, let's start with the mothership. Dow's up about 14%. S&P 500 has a fantastic year, 25% up on the S&P 500. The NASDAQ has been the big winner. We know that. The Magnificent Seven, as they're called, these big tech giants. That index is up 45%. I didn't put the Russell 2000. The Russell 2000 is up around just about, in the late teens. So the real small cap rally in the US is yet to play fully catch up. India, Prashant has mentioned the stats already. Nifty up 20%, mid cap 45, small cap 54%. That's the performance on the small cap. Global markets, and this is an interesting one. Japan has been the outlier this year. Again, not many would have thought that the Japanese market, the Nikkei, is going to give you 30%. That's just the headline index in Japan. The Kospi is not too bad. It's kind of in sync with us, about 20% on the South Korean market. And China, and I'd kind of end with that question. I think a lot of people, when we come back in January, will also raise that same question. Remember, we keep talking about this, whether it's sell India, buy China, or sell China, or rotate back in India. We've had various phases of these trades play out in 2023, and we'll see what 2024 has in store.
Oh, absolutely. But for our own markets, today I think it's going to be a quietish start. That's what Asian markets are suggesting. We've had 2 good days on the trot where the markets have, closed at record high levels. So the bull run continues for our own market. The new levels in terms of highs on the Nifty, it's 21,801. On the sensex, it's 72,484. On the point about FI flows picking up, as Surbhi pointed out yesterday, 4,300 crore plus in terms of the cash market. This is over and above the near 3,000 crore of inflows that we had from the FIs yesterday. And in terms of gross purchases, today the FI's gross purchase number was close to about 13,500 crore, higher than the 10,500 crore of gross purchases that we had in the prior day. Cash volumes, is 35% higher compared to Wednesday and 65% higher compared to the average daily trading this year. So yesterday was a bumper day in terms of cash volumes. And just getting back to that point about January seasonality, markets have declined in January for the last 5 years. It's typically a seasonally weak month, and that's the stats will come up for you in terms of the declines that we've seen in the last 5 years in the month of January. But let's get you some money market views then to take the show forward. On the rupee, Lakshmanan V of Federal Bank says the increased likelihood of rate cuts by the US Federal Reserve has led to the dollar index struggling. Thus, all G7 currencies are trading at multi-month highs against the US dollar. The dollar's decline, combined with strong FI inflows, has been the primary reason behind the rupee's recent gains. He expects the rupee to trade in a range of 82.9 to 83.38 against the dollar in the upcoming trading session.
Lakshmanan V says that government bond yields edged marginally higher while the overall trading volume remained shallow heading into the end of the year. The minutes of NPC's latest meeting failed to provide any major directional triggers to markets. US yields have remained below 4% as markets factor in a higher probability of rate cut for Fed in March. In coming sessions, he expects the 10-year to trade between 7.1 to 7.25%.
Okay, well, lots of stocks that we will talk about today as well. So let's run you through the list of possible movers and shakers, which we'll discuss in our top 10 segment. Today we're looking at PNB, Wari Renewable Tech, Swan Energy, India Shelter Finance, Saturn Credit, RBL Bank, Federal Bank, IndusInd Bank and IDFC First on the back of positive news flow. Bank of Baroda is the only stock on the radar that could open in the red because of that massive increase in the interest rates they're paying on deposits. More on that in just a bit.
Taimur is now joining us, Managing Director and Chief Economist at DBS Group Research. Taimur, good to have you with us here. Thank you for your time. The rally's been pretty good in 23, Taimur. Just big thoughts for 24. I mean, top three big thoughts. Briefly, go on. Morning.
Right. Good morning. What goes down has to come up. So we saw in 2023, I was hearing some of the numbers you were citing in terms of dramatic developments and impressive returns in various parts of the global economy. But the really impressive parts were the ones that were beaten down in 22, had room to recover in 23. Turkish dollar debt, who would have thought that would be one of the best bond performers in the world, uranium prices, cocoa prices. So when we look into 24, I think we need to also think about things that did very poorly in 23. Do they have room to run in 24? And I think therein lies the most contrarian view of the all, which is China. We are reading story after story in the last 1 week or so about investors withdrawing huge amount of capital from China. We haven't seen any good news out of the China macro over the last, I can't even remember when there was a good piece of news out of China macro. But that tells me that looking at the track record, whenever something is beaten down a lot, there was always the bottom fisher. I would expect the China equities to surprise us, or at least there to be room for surprising us in 24. But the second one is that something that comes in with a lot of momentum tends to carry that momentum at least for a while, even in the new year. So there lies the, I suppose, the bullish view on both the U.S. economy as well as the Indian stock market. I heard your colleagues talk a little earlier about how in late 23, we're finally seeing substantial amount of ETF money, substantial amount of active portfolio money being allocated to India, which was quite not the case in 22. 22 and early 23, Indian rally was driven by local investors. Now we're beginning to see foreign participation. I expect that momentum to continue through the first 2 quarters of 24, if not longer. And the U.S. economy, look at the Atlanta Fed now casting for the 4th quarter. This was supposed to be the slow quarter after the blockbuster quarter in July, September. Turns out we're going to have well over 2% in the 4th quarter of 2023 as well. So the U.S. economy will step into 24 with an absolute Goldilocks mix, slowing inflation, likelihood of interest rate cuts, but not much slowdown in the real economy. So China undervaluation, momentum for Indian stocks, momentum for the U.S. economy would be my 3 big themes for 24.
So talking about the US economy, there is a lot of euphoria surrounding the extent and the timing of Federal Reserve rate cuts. Goldman Sachs is predicting that the first rate cut could come in as early as March. Where do you stand on that for 2024? The timing and the overall quantum?
Right. Our view is that the expectation of the U.S. rate cuts could be a bit premature. There's been substantial easing of monetary conditions around 10-year bonds rallying in the last couple of months. So in a way, the market has already eased monetary policy for the Fed, gotten a bit ahead of itself, in my view. And the Fed, as it steps into 24, sees overall growth momentum being very strong, very mild signs of slowdown here and there, would have absolutely no urgency to cut rates unless we see some major news in the next 2 months of delinquencies for consumers. So you need a set of bad news for the Fed's hand to be forced in March of 2024, or else, in our view, rate cuts are going to be backloaded in the second half of 24.
Taimur, hi. Good morning and season's greetings to you. Sometimes you get a little worried when you can't think of the risks or the negatives. Like you're saying, it's a pretty much a pretty Goldilocks scenario as we set into 2024, right? So, barring geopolitics, is there anything else? Any risk that perhaps we should remember?
Yeah, I think that it is highly unusual for a cycle where rates are hiked of this magnitude to end without any financial stability issues. We saw a little harbinger of that about 9 months ago when regional banks in the U.S. came under stress because of duration mismatch. I think that there is a vast swath of the private capital markets, and by that I just don't mean the U.S., I also mean India, where there is a risk of duration mismatch, where people have borrowed in low interest rate times are now facing substantially higher rate times. And I worry that some of those financial accidents could manifest. And that, of course, would, talking about forcing the Fed, would force the Fed pretty quickly. And therein lies the two-pronged approach of monetary policy in the U.S. The quantitative tightening aspect of the interest rate. We can probably see some degree of communication or quantitative tightening if financial stability issues were to be mind in the coming months. So that's one big risk, no question about that. Second issue is inflation. Right now, everything looks wonderful. Commodity prices have come down, services prices have stabilized, but I think there's still a lot of tightness in the economy in terms of supply-demand of labor. There's a lot of tightness in the U.S. economy in particular with respect to extra liquidity. Despite a year and a half of quantitative tightening, there's still a lot of liquidity. Those things can go ahead and spoil the inflation picture. One should not be shocked about that. So that's another risk in the horizon.
All right, Taimur, great to have you with us here. Thank you very much for your time. So that's the global picture and some risks, perhaps, which could play out, which are not in the price right now. We'll take a quick commercial break here. Our research team joins us with the list of stocks to watch out for, the top 10 list coming up in just a bit from now.
CNBC-TV18, embarking on a quarter-century of excellence. Embarking on a quarter-century of excellence.
Welcome back. You're with us on Bazaar Morning Call. Let's straight away take it to our team to talk about the key stocks that we need to watch out for today, this Friday, last trading day of the year. Guys, so let's kick it off. We've got, of course, Vivek as well as Abhishek joining in with some of the key movers and shakers. And the banks are what we're watching out for. Abhishek, BOB, I guess the headline is on this huge increase in the rate of interest on fixed deposits, right? That BOB will now offer?
Well, Bank of Baroda, one of the few lenders to see such steep rise in their deposit rate, and this is on the shorter tenure of deposit. So, revises their interest rate upward on retail term deposit by as much as 125 basis point. Highest increase in retail term deposits by a lender at one go in recent times. Now, short-term money has seen massive rise in rates as follows. So, 7-day to 14-day deposits, retail term deposit at Bank of Baroda Baroda. Over there, the interest rates have increased by 125 basis points. 15-day to 45-day, that's increased by 100 basis points. However, on the longer tenure, that is between 1 year to 2 years, the increase is only 10 basis points. And above 2 years, the retail term deposit, there is no change. Retail term deposits form close to about 39.85% of total domestic deposits that the bank has. So bank has actually lowered their guidance on net interest margin in FY24 in the previous call to about 3.15%. There could be near-term pressure on the net interest margin of Bank of Baroda due to steep rise in interest rates. Back to you.
Thank you very much for that. Let me go across now to Vivek for Swan Energy and Vari Renewable. Vivek?
Well, good morning. Absolutely right. So, Vari Renewable Technology, a company we don't speak about too often, but making its mark as far as the solar renewable energy space is concerned. So, yesterday, a very interesting collaboration announced by the company. They have collaborated with an Australian company known as 5B Industries Pty. Now, this particular collaboration is for the production of Maverick box in India that Australian company is quite famous for, the local market development for Maverick solutions that the Australian company provides. Now, what is 5B? 5B is an Australian solar power product company, and when you're talking about Vari Renewable Energy, this particular company is the solar EPC arm of the Vari group. The other stock on our radar is Swan Energy. Now, what's actually happened is that the company had earlier approved a fundraise that would be have done via the preferential route. However, due to the timeline being elapsed, that particular fundraise has not gone through. In yesterday's board meeting, the board has approved raising funds up to 4,000 crore, and this particular fundraise can be done either via the QIP route or the rights issue route.
All right. Thanks very much, Vivek, for that. Let's talk about Punjab National Bank next. Financials, PSU banks, very much in focus. Back to Abhishek. Abhishek, morning.
Well, Prashant, along with PSU banks in focus, fundraising by lenders have seen a massive spree this year. So, PNB has taken a board approval to raise up to 7,500 crore in FY25. This will be done via QIP or follow-on public issue. So, entirely equity raise that we are going to see for PNB. Now, calculation shows at yesterday's closing price, the Tier 1 ratio can improve by more than 1% to about 13.08%. Equity dilution will be about 3.6%. Net worth will increase by close to 8%. Book value will increase by more than 4%. And Government of India's stake can reduce by 125 basis points if this fund raising goes through. Back to you.
Okay, all right, got that. Thanks very much, Abhishek, for the details on that one. Let's just quickly move on and talk about India Shelter Finance. Abhishek, why are you watching for this? Is it just the numbers?
Well, the numbers have come out and the P&L looks really strong. The net income, that is net interest income plus other income, that's grown by 47.8% YOY and about 16% sequentially. They have seen improvement in their operating efficiency as cost to income ratio has declined to 40.6% versus 46.7% in the same quarter last year and about 45.8% in the previous quarter. So operating profit growth is massive at close to about 65% YOY and 27% sequentially. Slight hiccup in provisions has been seen. However, PAT has grown by 67% YOY and about 27.9% quarter on quarter. So strong set of numbers coming in from India Shelter. Back to you.
Okay, busy day for you, Abhishek. You've got some more stocks in the news which you're tracking.
Well, to begin with, Satin Credit Care, they have had a co-lending agreement with Karnataka Bank. Good for them at a time when, RBI is making it expensive for NBFCs to get money from banks. This is a good agreement over there. Now, stake increase is seen for ICICI Pru Life and ICICI Pru AMC in various lenders. So, RBI has permitted both the entities, ICICI AMC and ICICI Pru Life, to increase their collective holding to about 9.95%. Currently, ICICI Pru Life holds about 3.2% in RBL Bank. Federal Bank, ICICI Pru AMC has got a nod to raise their stake to about 9.95%. Right now, they hold about 1.93%. In IDFC First Bank, ICICI AMC as well as Pru Life Insurance collectively will acquire about 9.95% stake. Currently, ICICI Pru Life holds about 1.39% stake in the bank. For IndusInd Bank, both the entities, ICICI AMC as well as Pru Life, can hold about 9.95% as per RBI approval. Currently, ICICI Pru Life holds about 1.26% in IndusInd Bank. Back to you.
Okay, got that. Thanks, Abhishek, very much for all of the list of stocks there. Let's quickly recap the list then. The ones that have positive flow around them are PNB, Wari Renewable Tech, Swan Energy, India Shelter Finance, Saturn Credit, RBL Bank, Federal Bank, IndusInd Bank and IDFC First Bank. The stock with the negative news flow around it is Bank of Baroda. Okay, with that, let's move on and see what the top brokerage notes this morning are looking like. Sudarshan has the details there. Sudarshan, morning.
In the list of brokerages today, I have 3 stocks. First, from oil and gas space, Motilal Oswal has a buy call on GAIL and target is rupees 195 per share. It says re-rating is on cards, driven by sharp improvement in return on equity and free cash flow. It expects ROE to improve to 15% FY26 from 9.5% in FY23. It expects healthy FCF generation of rupees 4,560 crore in FY26 versus 4,530 crore in FY23. It says core earnings of the company is strong and earnings visibility is higher as transmission contribution continues to improve. Next is DAM Capital on Venus Pipes. It initiates coverage with buy rating and target is rupees 1,810 per share. It says company is an emerging contender in the stainless steel pipe sector with hunger for growth and it's building a niche for itself in high margin stainless steel pipe space. Next is DAM Capital on Ratnamani Metals. It initiates coverage with buy rating and target is 3,950 per share. It holds a leadership position in steel tubes and product mix for both stainless and carbon has kept margins stable. It has a stellar capital allocation track record and strong net cash balance sheet despite capex plans.
Sudarshan, thanks very much for that. So those are, brokerage calls coming through. We'll take a quick commercial break here. Siddharth Khemka, Head of Retail Research at Motilal Oswal Financial Services, will be with us. And we'll talk specific stocks with him. And we'll be also joined by the management at 5-Star Business Finance to discuss their outlook going forward. Stay with us.
CNBC-TV18, embarking on a quarter-century of excellence. Embarking on a quarter-century of excellence.
Welcome back. Let's invite Siddharth Khemka on the show now to talk about the market setup on the last day of this year. And it's been a phenomenal year. Siddharth, thank you very much for joining in. Well, the year belongs to PSUs. It's been a blowout performance. Most of them have doubled, tripled in this year. Which ones, if you had to name your top 3 PSU bets for 2024, which ones would they be?
Yeah, very good morning and thanks for having me on the show. So if you look at, yes, there has been a big run in the PSU, I should say public sector enterprises as a whole. And there have been several reasons for that. Clearly there has been an improvement in the business, in the financials, in the growth. And there's a lot of them have shown sustained improvement in the return ratios. One factor that was the biggest missing link for the public sector enterprises, where the efficient use of capital was a big question always. But if you look across segments, that has improved a lot. Financials have improved, balance sheets have improved. So within those space, banking is one space which we continue to like a lot. We believe that what we had expected at the start of the year, that some of these PSU banks could start delivering on the 1% plus ROAs, that they have now delivered. And the leader among them, SBI, is something that we continue to like. We now expect that SBI could now, on a sustainable basis, improve the ROAs from 1% to 1.2%, and that should lead to the consistent re-rating. All the other matrices continues to remain strong. So that is one of our preferred picks within the public sector space. SBI, we have a target price of 800 from the current levels, which could gives a good, decent upside. The second stock is from the mining space, Coal India, which is our top pick for 2024 as well. We see robust volume growth and strong demand, which has been driving the power sector. So that will lead to the increasing volume for Coal India. E-auction continues to see some traction where we expect the company to sell around 10% of volume, which would have a premium to the spot prices. And to top it all, Coal India has intensified its focus on capex over the last few years, basically to improve the evacuation infrastructure. This will only lead to higher production and more volumes. Valuations continues to remain very attractive. The stock also has a good dividend yield. So on a FY26 EV EBITDA, it is trading at 4.2 times. It offers an attractive dividend yield of more than 5%. So again, that's the second pick from the overall PSU space. Coal India, we have a target price of 430. Again, another 18-20% upside from current levels. And finally, another PSU stocks from the oil and gas space, which is GAIL India. We would have seen the report that came out today. Again, one of our top picks for 2024. We believe that the transmission volumes would be something that would drive the business for GAIL. Turnaround in petrochemicals is also leading to an improvement in ROEs. Another example where we said that PSUs are now sustainably basis showing an improvement in ROE. So we are expecting ROEs to improve from 9.5% in FY23 to about 15% in FY26. That's a huge, almost doubling of ROEs. So that is something that we like, and the company is also likely to report free cash flows of 45 billion rupees in FY26. So overall valuations is something which continues to remain comfortable. And with the improvement in volume growth, improvement in ROEs, we believe that re-rating for a stock like GAIL would be there. So we have a target price of 195 on GAIL.
Okay, all right. So lots of PSU picks there coming in. So that stay on. We'll have more questions for you in just a bit. But we also have to get our first corporate conversation going for the day. Now, we've been speaking to, of course, a lot of banks and NBFCs over the last few days and weeks to understand how they're being impacted by the RBI measures on unsecured lending. We have now with us Lakshmi Sampath Deendayal, and Chairman and MD at 5-Star Business Finance, to talk about, of course, their business outlook for the new year and also how some of these regulatory measures are playing out. So thanks for joining in, and season's greetings to you. So that question really first, now it's been a couple of weeks since the RBI tightened its screws on both on the unsecured portfolio of banks and also the loans that banks are giving to NBFCs. Has this started showing up for you in any way in terms of your cost of funds? What are banks telling you when you are talking to them about fresh lines of funding?
Yeah, thank you for this. Let me start with a very clear note to the viewers that 5-Star is a 100% secured lender. So we don't have any unsecured portfolio in our book. We lend to small shopkeepers, self-employed of this country who are not being lent by the formal lenders. We are getting into that market and doing it very successfully for the last 20 years. So all the loans are backed by hard collateral. 95% of the loans are backed by the self-occupied residential property where the applicant family members live in, and 5% can be the commercial property or some vacant lands. So first point, let me be very clear. 5-Star is a fully secured loan lender. So as you rightly said, RBI's concerns are more towards unsecured loans, short-term loans. So 5-Star doesn't get into this bracket of unsecured loans and short-term loans. Our loans are for 7 years for business use and housing end use. On the second point...
Yes, sir. Please go on the cost of funds for you.
Yes, I'm coming there. Yes, RBI's new circular, banks lending to NBFCs in total, risk weightage has gone up. We were, in last quarter, September quarter, our incremental cost of fund was 9.5% and book cost of fund was 9.7%. Almost 3 months have gone after the circular has hit banks and NBFCs. We have raised close to 1,000 crores in last 90 days. We are borrowing at 9.59. So there is a 9 bips increase. But what guidance we have been giving to the market till these things get settled, the cost of funds for 5-star will move up 25 to 35 bips in total.
Okay. Mr. Dinder, good morning. Prashant this side. Season's greetings. Good to have you with us here on CNBC-TV18. What is the last trading day for 2023? Just to, so NIMs will be where, sir? I mean, I think the last time you were on, you were saying that spreads should be between 12 and 13%, NIMs between 14 and 15%. Is that, is there any change to it?
Yeah. Good morning, Prashant. I remember the question, what you asked on NIMS contraction. So the NIMS contraction will happen in 5-star. I just wanted to repeat that. The NIMS contraction in 5-star will happen because the leverage is going to pick up. So more and more debt we borrow, the NIM contraction will happen. On the steady state, what we are guiding to the market 3 years, 4 years down the line, our spreads will be at 12-13% and NIMs will be around 14-15%.
What about sort of loan guidance, sir? Is there any change to that? I think it was 30%, the last communication to the market.
Yeah, no change on that. We'll be growing at 30% for this financial year. And next financial year also, we hope to grow at 30%.
So I'm just repeating the numbers to make sure that we have them right. You said cost of funds will move up by 25 to 35 basis points, right? And that is what, over the next how many quarters?
Maybe you can take next 2 to 3 quarters till this gets settled. Maybe we will also see the rate cut kicking in from August, September next financial year. So I think that will get moderated. So you can take it for next 2 to 3 quarters.
And NIMs in a range of 14 to 15%. Again, is that a guidance for the same period? This 2 to 3 quarter period? Over.
No, this is at a steady state. What we are giving to the market, it's 3 years down the line. Our NIMs for this year and next year will be in the same range of around 17 to 18%.
So, does the demand from the sort of the small business loan segment, shopkeepers, etc., self-employed, is that as robust as ever? Is that picking up? I mean, what's going on? Just some qualitative, yeah.
Yeah, it has picked up very strongly, Prashant. That's what we have been guiding to the market. We have close to 475 branches across 9 states. The inputs what we get from the ground side is the demand is robust. That's why we did a 37% growth last year, and we continue to do that strong growth years to come. So we feel there's a very strong demand, and this is a very niche segment. Not many players are into it, and I think as long as 5-star grows thoughtfully on reaching the customer, underwriting the customer, and collecting back the EMIs from them, we see a very strong demand at the ground level.
Okay, all right, Mr. Deen Dayalan, we will leave it on that note. Thank you very much for joining in and giving us a lot of clarity on just how cost of funds and how margins will shape up in the medium term. Thank you for being with us, and wish you a very happy new year in advance. Siddharth Khemka is still with us. Siddharth, I guess you could perhaps listen into that conversation. And this is a hot topic, right? NBFCs and what lies ahead as we go through this phase of repricing of lines of credit. What's your sense on, I don't know if you track 5-star, if you do, then give us a specific take on this one. And in general, NBFCs in 2024, could this be a dark horse segment, or, would you be a little concerned and would you stay away, given that some of these margin issues will play out?
Yeah, hi, Surabhi. So I think, yes, it has been an interesting discussion, especially after the notifications from the RBI with regards to the non-secured or the unsecured lending, and the reaction to that has been pretty sharp, especially from certain segments of NBFCs. But what we see is that the repo rates have stabilized, and the narrative of interest rate cuts is now emerging, which should kind of help elevate the concerns regarding the NIM compression. And so overall, we have a positive stance on the NBFC sector. We expect that there could emerge some kind of margin expansion in the second half of 2024, and also led by some of the credit cost kind of coming down. Vehicle finances are something that are better placed than other segments, as we see the rates picking out and the margins bottoming out over the next 2 quarters. So as I said, we are expecting margins to stabilize and then gradually expand as some of the existing books is replaced with the higher yielding new loans. So asset quality continues to improve, and that is something that kind of gives some comfort. And as I said, we kind of like the vehicle financiers much better in this environment where auto sector has seen a strong growth, and that is leading to them being placed in a better situation. So M&M Finance is something that we like along with Shriram Transport Finance.
All right, so that a point taken. And we'll just come back to you for some more commentary. Now, let's just talk about Reliance Industries. The chairman of RIL, Reliance Industries, Mukesh Ambani, has outlined a compelling vision for the company's future. Speaking on the 91st birth anniversary of Dhirubhai Ambani, which is celebrated as Reliance Family Day, the Reliance chairman said the company can and will grow to be among the top 10 business conglomerates of the world. Reiterating the importance of digitization, the Reliance chairman urged his staff to be at the forefront of using data with AI as an enabler for achieving a quantum jump in productivity and efficiency. Mr. Ambani further added Reliance should accelerate the efforts to become a pioneer in developing AI to address India's urgent national priorities in education, healthcare, agriculture, and employment creation. Mr. Ambani also had an advice for the younger generation. He said young leaders should not waste their energy on conducting a post-mortem on past mistakes. Rather, they must learn and not repeat the same mistakes in the future. Listen in.
As India races ahead to become the world's third largest economy, an unprecedented opportunity awaits Reliance. Reliance can and Reliance will grow to be among the top 10 business conglomerates of the world. In 3 days from now, we will say goodbye to 2023 and usher in 2024. As the head of the Reliance family, I would like to share with all of you 3 more key messages for the new year. Let me summarize them as 3 consolidations. First, let us consolidate Reliance's place among global leaders in digital platforms, data, and AI adoption. Second, let us consolidate Reliance's place among global leaders in talent enrichment. And third, let us consolidate Reliance's place among global leaders in institutional culture.
All right, so the 3 big strides and the 3 big focus areas for Reliance as we step into the new years. Now from RIL, let's move to the Tata Group. Chairman N. Chandrasekaran has asked employees to brace for more disruption and volatility in 2024. In his New Year message to employees, he highlighted that 40 countries are heading to polls in 2024, and complexity in global governance will reach new heights as the world attempts to regulate data privacy, artificial intelligence, and carbon emissions. In his New Year message, Chandrasekaran also said that India's future is bright. Amidst all this uncertainty, he identified 3 areas for the group to prioritize: execution, customer satisfaction, and technology. Okay, so those are, of course, the big messages from the big, tall leaders. So that's a bit, I'm not asking you to really talk on the commentary there. We've got a big visionary speaking. But let's drill this down to, the market's hopes and expectations from both Reliance as a stock and, of course, the entire Tata Group as well. For RIL itself, given all that's happening on, across its various platforms, whether it's retail or digital or the core O2C business, what's your expectation from the Reliance stock in 2024?
Yeah, so I think Reliance, after the underperformance, should now take leadership. If the index has to move further from here, Reliance can no longer sit back and relax. And if you look at the concerns, especially for this year, has been the higher debt that they have been taking because of the newer investments and the newer businesses that they've got in. I think market will start already discounting that factor. So market will start looking at the core business, where again the core oil and the oil, petrochem and the chemical business that has started doing well. Crude oil prices have been stabilizing. We saw the margins, GRMs moving up, down, and everywhere. It should now be stabilized because we have seen a lot of changes, geopolitical issues globally as well. So overall, if you look at our Reliance Jio, the business growth has been pretty steady. Retail, again, something we saw across the board. Start of the year, things were not that good, but towards the end, the growth started coming back to the retail space, where Reliance Retail continues to do well. And the key that that the market will continue to watch is the standalone business, where the company has been able to deliver sustained performance. So we believe that segment-wise, the consumer business continues to do well with double-digit EBITDA growth, RGO as well as Reliance Retail likely to record a 15 and 30% CAGR over the next 2 years. And as I said, growth will be driven by retail sectors, footprint addition, new categories. So overall, we like Reliance. We believe that the company should do well now, with the core business also doing well. We currently have a target price of around 2,760. That's a decent upside. And as I said again, the stock should now start participating in the market with the underperformance having done by.
All right, Siddharth, we'll take a quick commercial break here. Hang in there. We'll come back. We'll also get you the trade setup on the technical side. Mitesh will be with us, and so will Shrikant Chauhan this Friday morning. We're just coming back. There's 10 minutes to go for the pre-open session as well. Stay with us.
CNBC-TV18, embarking on a quarter century of excellence. TV18, embarking on a quarter century of excellence.
Welcome back. We're 130. The market ended 130 points high yesterday, and this morning I think there's been a bit of a turn for the positive as well, with a 20-point uptick in the morning. I think it was largely flattish to even slightly lower, but that's turned around. Mitesh is with us, and so is Shrikant Chauhan with a quick technical setup in terms of how things are looking. Gentlemen, good morning. Good to have you here. Mitesh, let me start with you. How are things? Okay, I think some problem with Mitesh. Shrikant, you want to come in first? How would you sort of trade the market? What would you do?
Good morning, Prashant. Good morning, everyone. I think the markets are just going up on a daily basis, on a regular basis. And after hitting the lows of 21,000 just 4-5 days back, now the markets are very close to the crucial psychological resistance level of 22,000. So the ideal strategy should be to look for taking some profit between 21,900 to 22,000 levels, because then the markets will be very close to the crucial overbought levels. But at the same time, there is a lot of stock-specific activity in the market. And also, it's the last day of the month and year. So we may see some stock-specific activity in today's day. Broadly, we are of the view that we need to focus more and more on PSU banks, metals and minings, and some fertilizer companies. So the strategy should be to look for adding position if there is any correction in the market. Otherwise, we need to be more and more stock-specific. 21,600, 650 are the levels where we should look for adding positions. And for the Bank Nifty, there also we are seeing 49,000 as a resistance. But in case if there is any correction, then 48,300, 48,200 will act as major support for the Bank Nifty.
Okay, buy on dips, but the dips have been quite shallow over the last couple of days. Mitesh is with us now. Mitesh, what would your index trade be? The GIFT Nifty is now picked up a bit, and Asian markets too are holding up quite smartly despite a mixed finish on Wall Street. So Asia is providing that support this morning.
So good morning. My sense is that I think we should continue our journey on the upside. I think Shrikant highlighted an important point of 22,000 being a round number, a psychological number. So even my targets are around 21,950, 990. I think that's the area I would want to take some profits. The key here would be Bank Nifty. After underperforming for the last many weeks, last 2 weeks, it's kind of trying to get back into outperformance mode. And, I think that's the index which could possibly head towards 49,200, 500 area. But if that is cleared, then even 50,000 could be surpassed. So we'll keep a close watch over there. Lot of stocks from the private sector side, which is stocks like HDFC Bank, Kotak Bank, IndusInd Bank, are showing good strength on the medium-term charts. So I think the bank nifty could be a good index to trade.
Okay, we'll slip into a very short break, gentlemen. Do stay on. We'll come back with the pre-opening rates and we'll get your stock-specific ideas too. Also, on the other side, Amit Dixit, analyst at ICICI Securities, will join in to put the spotlight on the metal sector.
CNBC-TV18, embarking on a quarter century of excellence.
Go powered by
CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. The Indian markets have closed at record highs for the second consecutive session yesterday as we rallied up and closed at levels closer to 21,800. Will the optimism continue in the last trading day of 2023? The GIFT Nifty is now picking up momentum, 55 points higher. There has been a decline in crude prices now to levels of $77, $78 per barrel. And plus, the FI inflows have been very strong. So widespread buying seen by the institutions. These are the early rates, and the Nifty is opened in pre-opening above 21,800. Let me get back to our experts for a few stock-specific ideas this morning. Mitesh, what would you have?
So I have all buy calls today. I have a buy on HUL, and we've had buys in the last few days there. I think this is a stock which is starting some kind of an up move, which could last for the next few days to come by. So buy here with a stop at 2604, targets of 2700 can be looked at. IEX is a buy with a stop at 158 for targets of around 172. DV's Lab is a buy call as well. Keep a stop below 3900, look for targets of 4025. And the final call is ITC. Disclaimer, it's a recommendation to our clients. I also have some futures positions, so there is vested interest. ITC is a buy with a stop at 458 for a target of 475.
Shrikant, what about you? What are your picks?
Yeah, I would like to go with those stocks which are very close to their breakout levels, like Bank of Baroda has crossed its previous pivot level of 229 to 30. So from here, the stock can move to the next levels of 245. So it's a buy at current levels with a stop loss close to 225. The other stock which we like is quite interesting, that is RCF, and it is like forming some V sort of recovery sort of pattern. So from here, the stock can move to the next levels of maybe 160, 165, and maybe in the long run 175. So RCF is also a buy at current levels with a stop loss close to 155. And the other stock which we like is Tata Steel, and metals and mining stocks are really doing well, NMDC, GMDC, but Tata Steel is now very close to the crucial level. And from here, the stock can move to the next level of 150. So it's a buy at current levels with a stop loss close to 134.
We're talking about metals next. But in Shrikant or Mitesh, nothing on Hindustan Copper? I mean, Mitesh, I think we were talking on Hindustan Copper yesterday, and you said that you had a trade far lower. Of course, it's run up like crazy since. But any fresh trades, Shrikant or Mitesh?
Hindustan Copper, I think the stock is forming some rounding bottom sort of formation. And if we see the entire pattern of the stock, then in the month of October 2021, that is almost like 1.5 years back, the stock was close to 200 levels. From there, all the way, the stock corrected back to 80 levels, and now again it is returning back. Most of the PSUs gained nearly 10 times to 12 times in the same period. So we may see further more activity, at least 50% of the entire fall of the all lifetime highs. So we may see the levels of 330, 340 in the near term. That's the view on the Hindustan Copper. But the way there is volume and the price pattern, I think if there is any correction close to, let's say, 230 or 35, we should look for adding these stocks with a medium to long term.
Okay, well, speaking of metals, we've discussed the trades and perhaps the technicals that one can keep in mind. What about the fundamentals? What's really going on over here? The Nifty Metal Index, that's up about 3.5% this week. But for the month of December, the rally has been stunning, 12% up in the month of December itself. Amit Dikshit is now joining in to throw a light on this. Amit, thanks for joining in. Season's greetings to you, and I hope you're geared up for a great new year. So, what's at play over here? Because on one hand, we keep talking about the possibility of the slowdown/recession in the US. I mean, I don't know if China has really started to sort of stock up in a big way, but what are the big triggers that have led to this big December rally across the metal spectrum?
Yeah, hi, good morning. So if you look at the rally, it has its legs again in China. There is the usual optimism around around China actually bruising up stimulus measures. And I think the entire street is geared for that. And this is not a new thing. I mean, it is a textbook of whatever happened last year. Last year also in December, we saw that there was a lot of euphoria around metal stocks, particularly steel, because of expectations of China injecting stimulus. Now, the proof of pudding is in eating, I would say. And what we have seen so far, at least that in China, the stimulus measures, the intent is always there, but we have seen the efficacy of these measures not as potent as it used to be in the past. So basically what I read from here, going by the spreads that are there in the third quarter of the year, which have compressed because of robust coking coal prices and the fact that in India, the imports have been relatively higher. In fact, it's quite surprising that India is now a net importer of steel. So clearly, fundamentals don't really support it all the way through. I mean, it's not a blanket call for all the stocks, so you have to be a little bit discerning over here. But I think it's more because of China euphoria, number one. The rally in the non-ferrous names is mainly because of the possibility of US going for rate cuts later this year.
So it's more of a trading, perhaps, a rally than fundamentals. Let's just talk fundamentals then to understand. Let's start with ferrous. You're saying that spreads are actually compressing. What's the immediate forecast? I mean, January, February, both in terms of demand overall, and also just how the spread situation is likely to move. And is there any reason fundamentally to be buying steel stocks now?
No, so again, in steel, there are stocks that are based on infrastructure, like your SAIL, JSPL. These are the infrastructure-focused stocks, essentially, and these have done quite well. Now, if you look at what lies ahead in terms of demand, well, demand has been quite robust, to be honest. I mean, I have never seen that in 3 years in succession, FY 22, 23, and 24, we will see a double-digit growth in steel consumption in the country. And that has actually led to the absorption of the capacities that have come on board. And the fact that, imports are continuing unabated just because Chinese imports or exports have been quite high. So therefore, that is putting the plug on prices. Now, spreads is more guided by the fact that coking coal has been very, very robust and it has not really fallen materially. While because of influx of imports, we have found that steel prices have not risen proportionately, and that has led to the erosion in spread. As far as the demand is concerned, demand is perfect. I mean, there is absolutely no qualms about the demand.
By the way, on that point about rate cuts fueling the recent metal rally, there was a Bank of America Merrill Lynch report which Manisha had spoken about. They said that we've seen 300 rate cuts across the globe from 2021 to 2023. And now in 2024, the expectation is from the Bank of America report, there will be 152 rate cuts by central banks in 2024.
152?
152 versus 300, 152 rate cuts next year versus 300 rate hikes that we've seen from 2021 to 2023. But very quickly, Amit, copper, what's the outlook on copper? And do you look at Hindustan Copper?
No, so we don't look at Hindustan Copper specifically, but as far as copper is concerned, well, if there is a possibility of rate cut, copper is the most investable idea in the space. So normally people expect copper prices to go up. So that is one thing. Then the second thing, what might be happening in Hindustan Copper, though, that there are a lot of houses who are talking about setting up a smelting plant in India, copper smelting plant. And in India, Hindustan Copper is the only one that is mining out copper. So clearly there would be time, possibly like Hindustan Zinc, when Hindustan Copper would also find its real potential. And I think because of the possible rise in the copper prices, this is what is driving Hindustan Copper. Although we don't cover it formally, so I can't comment on any estimates or something like that.
Okay, all right, Amit, we'll leave it on that note for this morning. Thanks very much for the perspective, and once again, wish you a happy new year. Very quickly, let's move on to an important regulatory development. Now, SEBI yesterday came out with a consultation paper to come up with rules that will determine how companies should be looking at market rumors and the clarifications that companies should issue in the event that there are some market rumors. Now, what is a rumor? That's the fundamental question. And SEBI is looking to link this with the movement in stock price. Let's bring in Yash to first quickly understand what SEBI is proposing. Yash, tell us more.
Well, Surabhi, as you rightly pointed out, two important aspects to this consultation paper from SEBI. One is what should be considered as a market rumor, and the second part is that if it is considered as market rumor, what should be the process in which a clarification from the listed company should come about. As far as the consultation paper is concerned, SEBI has made a change in the basic premise of what should be considered as a rumor itself. Now, any news or any rumor in a notable publication which brings about a material price movement in the stock price of that listed entity, that will be considered as a market rumor, and that will require the company to clarify on that particular rumor. Now, the obligation to clarify will be on promoters, directors, KMPs, senior management, and the obligation will be to give an adequate, accurate and a timely response as far as the rumor is concerned. Now, let's just break up, this particular piece of consultation paper in three parts. One, what will be considered as a material price movement. No number or no, specific idea given by SEBI, but what regulator says is that a lower percentage of price movement in a security which is in a higher price range should be considered. Higher percentage for securities in a lower price range should be considered. Indexation with Nifty sensex movement on the same day will also be considered. This will be applicable on top 100 listed companies from February 2024 and top 250 listed companies from August 2024.
Okay, thank you very much for that. Let me go across to Abhishek then for the Momentumizer stock of the day. Abhishek.
Well, Rima, GAIL is on radar with respect to Momentumizer of the day. The stock has outperformed Nifty in last 1 week as well as last 1 month. So a weekly gain in GAIL has been about 11.66%. This compares to 2.5% gain that you are seeing on Nifty. Monthly gain is about 25.5% when compared to 9.5% monthly gain for Nifty. So in terms of volume data, yesterday the volume was close to 580 crore, which is the highest in last 3 days. And yesterday delivery volume was about 39.1%. With respect to the stock price is just 1.1% away from its 52-week high. We also have a brokerage note today from Motilal Oswal, wherein they have a buy recommendation and they have increased the target price to 195 per share. They expect ROEs to improve to 15% in FY26 from 9.5% that the company did in FY23, and they expect healthy FCF, that is free cash flow generation, of 4,560 crore in FY26, which compares to 4,530 crore that the company had done in FY23. Back to you.
Okay, thank you very much for that. We begin the January series today. Mangalam joins in with the setup and how typically markets have fared in the January series. Mangalam, over to you.
Well, I'll start with saying Happy New Year, because as per FNO, we're already in Jan 2024. So, it's a phenomenal December and November series that we've seen. On a point-to-point basis, it's actually the highest absolute gain that we've seen in any series in December itself, 1,650 points. In the last two series itself, 3,000 points added on the Nifty, 8.2% in terms of a gain on the Nifty itself. The question now is what happens in January. Typically, January has been a softish month for the markets, as the last 5 Jan series will tell you 4 of them ended on the negative side, not by much, but just about 1.5% over the last, 4 January series itself. And there are a couple of data points that tell you that maybe the market could be a little overbought. Why? One, the December to Jan rollovers are close to 80%, which is higher than the 3-month average that we've seen out there. Not just that, the Nifty open interest is close to 1.3 crore shares, which is a good 30% higher than the 3-month average that we've seen itself. And these rollovers and long, open interest positions have been all added on the long side. The FIIs, which at the start of the December series were 36% long, have now increased their longs, doubled their longs to 70%. And every time over the last few series where the FII longs have been 70% or more, the Nifty in that series has been lower by 300 to 400 points. As we can see, December 2021, the FII started with 70% long exposure. The Nifty was down 330 points. As recent as last December itself, the FIS was 77% long at the start of the series. The Nifty down 300 points. What are the key triggers that we're watching out for? The first thing will be the third quarter results and the management commentary, pre-budget conversations with regards to vote on account, etc., global markets and yields. And the other thing that we'll be watching out for is how the mid-caps fare, largely because at the start of a series, we have one stock in F&O band, that's Hindustan Copper, after a big move that we saw yesterday. And usually that does not typically happen.
Okay, all right, Mangalam got that. Thank you very much. Hindustan Copper has been quite the star of December. Just about 20 seconds to go. So the opening could perhaps be on the negative side, and that's in sync with what a lot of Asian markets are doing. There's some profit taking pretty much across the board. It has been quite a stupendous week for the market so far. So perhaps we start out a little soft. The Bank Nifty is the one to watch. Can the dip get bought? Because right now the Bank Nifty is indicating a negative start to about 0.25% or so. So that's, of course, something that we will keep in mind, as well as stocks like Reliance, where the top leadership has given out a lot of commentary and expectations on 2024. Okay, we kick things off with a 40-point decline on the Nifty and about so it's in sync. The decline on the Nifty and the Bank Nifty right now is absolutely in sync. 0.25% down on both of those indices. Mid caps have started out slightly positive. Where is the lag coming from on the large cap space? BPCL, Coal India, SBI. These are some of the PSU names, the large cap PSU names that have started off with some profit taking. Then you've got Infosys, which is starting a little lower. HCL Tech is down, as is HDFC Bank. So banks, again, are responsible for some of the ease off in the morning. Kotak is down about 0.5% as well. So banks subdued, some of the PSUs looking at profit taking. That's how it's playing out. And IT also on the weak side as we kick things off. TCS is down, for instance, about 0.2%. On the flip side, Adani Enterprises, Adani Ports, some of the Adani stocks are looking good. Reliance has reacted positively, about 0.2% up on Reliance. But it's a little quiet, you'd have to say. Just around 50 points lower on the Nifty. But I guess we can't complain. Given the year and the week, this is perhaps par for the course.
The mid-cap index is absolutely flat to begin trade with. Some of the stocks which are in the news, Saturn Credit Care opens with a gain of 4%. They've entered into a co-lending agreement with Karnataka Bank. Realtel has a gain at opening 3% higher after bagging an order worth 120 crore from the South Central Railway. RBL Bank, Federal Bank are some of the stocks on the banking side which are higher after RBI has given a nod to RBI Pru AMC and Pru to acquire further stake in these banks. On the losing side, ICICI Lombard is under pressure, 1.5% off the bat lower after it gets a tax demand and a penalty notice amounting to 1,900 crore rupees. Fairly sizable, and the stock it has opened with a cut of about 1.5%. So these are some of the stocks which are in the news. On the losing side, apart from that, you've got oil marketing companies. So we spoke about BPCL, but there are cuts on HPCL and IOC2, 2.5% lower. And this follows a 17% gain that we've seen for oil marketing companies in the month of December. Some of the PSU banks are seeing some cuts. So Bank of India is one stock on our radar. On the gaining side, you've got a Kalpataru project, smart 8.5% up move on that. EIL is seeing some buying, and Hootco is in the green. No big gains, but at least the gains of the last couple of days are very much intact there.
Okay, well, it's a down day. It's a down start, rather. I mean, we're down about 60 points now on the index. 21,717 is where we find ourselves at. Take a look at the Nifty Bank. Quick look there, and I think it should be following what the Nifty is doing as well. About a third lower. So just a few other names in the broader market. So the big volume-led gainer this morning is Sona Comstar, which is coming up with a 2.5% gain. Stocks at about 646. There is Mazgaon Dock, which is coming up with 1.6% gains, 2,321 in Mazgaon. Kalpataru, Rima mentioned. Kalpataru, by the way, we have the management joining us a little later on the show. 715. It's got large volumes at this point in time. Azad Engineering, which is the listing from yesterday, ended 30% higher. That starts another 4% in the green. with stocks past the 700 rupee mark once again. IEX starts about 2% higher. Venus Pipes, I mean, that's another name. There's a new initiation on Venus Pipes. Stocks up 6%, 1436 on that one. There is Aarti Industries, which is up about 2% or so. So this is the volume-led list that we want to get to you. Tata Consumer is up about 3% as well now, and it's got decent-sized volumes. Market breadth is, I mean, I think it's settled now. 900, I think 1,000 up, 900 down is the kind of picture. HP, which went up 10%, HPCL, which went up 10%, is down about 2.5%. BPCL is down 2.6%, and IOC is down 2%. So oil marketing, that is seeing a bit of cool off. It's been a frenzied run in the oil marketing pack that we've had. And there is India Mart, maybe we can look at, which is down a little bit as well. And Go Colors, I think we mentioned this. Go Colors is down 6%. Stocks at about 1,212 rupees or so at this point. So that's the overall picture. Market down about 60 points. We'll come back with more names in a bit from now. Andrew Holland is with us now, Chief Executive Officer at Avendus Capital Public Markets. Andrew, great to have you with us here. Thank you very much. So as we enter 2024, we'll have to get through January. And the reason I say that is because January seasonally, and I was putting this out in the morning, 12 out of the last 16 Januaries have been down. So there is a bit of seasonality there. I think it matters if you're trading. I mean, if you're investing, you can look past it because otherwise the overall picture looks pretty okay. Pretty good, actually. I mean, some of the fundamental drivers, etc. But if you're trading, what's the advice from here, Andrew?
I think it's going to be a choppy first few months, actually, Prashant, because I think, if you look, all the positives we know, right, in terms of interest rates, the Fed pivot, everything's there. But the market's kind of very quickly rushed and priced everything in. So there's no kind of room for any kind of error in this in terms of, if there's a escalation in the Middle East, if the Federal Reserve kind of delays, doesn't do a rate reduction in March, but leaves it till June. The market's just saying, no, it's all baked in, it's all done. And we're kind of off to the races. So whilst I'm not trying to pour cold water on the market moves recently, I think January will be a lot more volatile because I think some of these things will be tested. We'll test the market's resolve in terms of that Goldilocks scenario. So been great year end for all markets. But I think if we can consolidate, Prashant, in January around these levels, it'll be a victory because I think if anything we're getting into that overbought zone, which usually there'll be something that brings the market down in the very short term.
So are you fully invested or not, Andrew, as you enter 2024 in your portfolio, or are you keeping some cash in case the markets drop? You will go out and buy.
Yeah, no, we deployed. Fortunately, going into the back end of November into the elections, and then throughout this month, we've been luckily very, very fully invested. I think as we start to see the market consolidate, then we'd probably take some more money off the table, and then look for those opportunities, which I'm sure will present themselves in January fully for us.
And where might these opportunities be? Andrew, good morning. Surabhi here. Season's greetings to you. The question is, where could the opportunities be? In the same sectors, the same kind of stocks, industrials, PSUs that have done well? Or do you see some dark horses out there?
Well, I'm not sure there's any dark horses to which have got any value. Maybe chemicals might be the only one, but I'm not tempted there. No, so if you look at what we're saying, right, we're saying that interest rates are going to fall in the first quarter, by the end of the first quarter, and then maybe the RBI will follow suit in April. If that was the case, then obviously the banking sector still has a further leg to go. I know the RBI is at the sidelines worried about unsecured loans, so we have to kind of watch the regulatory part of that. But obviously, if interest rates are falling, NIMs come under less pressure, and corporate capex will start to pick up. So I think that bodes well for the banking sector. So I think that will be one of the drivers, along with metals and IT. So I don't think anything else is going to take us away from those three kind of sectors driving the market higher, particularly if foreign investors come in. They're going to come for large caps, and they're going to go for these three sectors because they're all interest rate sensitive, and because the dollar would likely kind of weaken in that scenario, metals will do well. And of course, we're all awaiting, and let's see if it happens, for some further stimulus from China, which again would have a great impact or positive impact for the commodity prices.
So, Andrew, so banks then, I mean, names like HDFC Bank, which are just now getting back to their previous highs, that's where the money is going to come into?
Yeah, no, into the large cap banking sector, yes, for sure. I think whilst I'm not kind of going away from mid caps and small caps in terms of a theme, I think it's the themes which will play out, which lend itself to some of these stocks. So, for example, you know, I've been talking to you many times about premiumization in the beverage industry. So there's many companies out there which will benefit from that, which would be in that kind of mid cap kind of sector. But I think if FII flows come in, if PI flow, foreign investor flows come in, then it's really going to be large cap where they'll kick off with their first investments.
You said you deployed money towards the end of November and through December. Do you want to tell us where you've allocated your money?
No, we've talked about this many times in terms of what would drive the market, and that would be obviously if after the Fed pivot, it had to be in the banks, IT, and metal sector. So those have been the drivers of the index. They've been the underperformers of the index as well up until recently. So it wasn't a difficult kind of thought process in terms of where the momentum would be. But also metals have been helped by what's been happening in China in terms of commodity prices there. I said, I think going into January, it's going to be a little bit more volatile. We're pricing in perfection in terms of all of our forecasts, and the market's not sounding any kind of alarm bells in terms of what could happen on the downside.
Andrew, how have you positioned for this, the sectors of 2023? Have you played that whole rally in industrials and defense stocks and PSUs? I mean, my God, who would have thought that PSU stocks will return 100, 200, 300%? What do you make of it? And what would your advice be? Is it time to lighten some positions here or just keep on riding?
No, I think throughout 2023 have been, government spending on defense, renewables. So those themes aren't going away from us. Those will continue, for the next 2 to 3 years. So, there's still a lot of growth in those sectors to enjoy over the next 2 to 3 years. We talked about travel and the hotel industry. And again, I think that's going to continue to increase. The per capita GDP of $2,500 now means people want more experiences. So you'll see more travel. So airlines, hotels will be a continuous theme for 2024. And then two sectors we could have picked on in terms of new themes that we liked. And at the very beginning of the runway was the electronics manufacturing sector, where, again, domestically and export-wise, it's just going to be huge for these companies in terms of both profitability and revenues over the next 3 to 5 years, and they're all growing at 50% compound. And the premiumization in the beverage industry is continuing. We have a huge young population. They want to try many different things. So I think that again is at the beginning of the runway in terms of revenue growth and margin growth as people move up the curve in terms of what they would like to drink or eat going forward. So I think this is going to be a huge sector. So those are the themes that we've been playing and will continue to play. In terms of the PSUs, we've always said, Surabhi, that we like to rent these stocks, not really own them, particularly in the banking sector. And that's the kind of view and trading view we'll have on the PSUs.
You said you're not very convinced about the specialty chemicals theme, about it bottoming out as of now. Do you want to tell us about the rural sector and in terms of demand picking up, in terms of the themes which have not done well, where there has been a cycle downturn, has been IT, chemicals, and to some extent rural demand or consumer discretionary at the bottom end? Amongst these three, you're betting on IT. Specialty chemicals, you said you're not convinced as of now. What about rural consumption for 2024?
Yeah, it's a good question. It's a kind of a mixed bag at the moment in terms of the feedback we get, from companies and obviously from the brokers who are kind of writing reports on their travels. I think if I look at what I think the drivers for the economy and mainly earnings in 2024 is the multiplier effect from the government capex and private capex that we're seeing now. So across many different sectors, I think that to start filtering through to the rural economy, going into the second half of 2024. But I think I'm not banking on the rural economy to kind of pick up and have that consumption. I think there's enough, in terms of, like, say, the premiumization in beverages, which will continue and help earnings. So I'm thinking that earnings growth will be around 15% in 2024-25, and I think the market could probably be in line with that in terms of the returns as well for 2024-25.
Okay, all right. Andrew, good chatting with you today. Appreciate you joining in. Wish you a fabulous end to 2023. Have a fantastic New Year's. And of course, we look forward to more conversations in 2024.
Thank you, and wish you all a very happy New Year.
Thank you very much. Well, with that, we'll move on now to our next conversation. And the company that we're putting the spotlight on is Patanjali Foods. The stock has seen a pretty good run-up in the last 3 months. The company also held an analyst meet recently in which it set a group turnover target of 45,000 crores for FY24. Sanjeev Asthana, Chief Executive Officer at Patanjali, is joining in to talk about these plans, the target and the business outlook. Mr. Asthana, thank you for joining in. Season's greetings to you. So big targets there for the fiscal that will end out. 45,000 crore group turnover is what you're looking at. So tell us, what do you think will drive it? And give us a specific outlook on the edible oils business. How are your volumes shaping up there? And how much of this growth, this turnover, group turnover, will actually come in from the oils business? How much would be FMCG? Give us a breakup of the numbers as you see them.
Sure. So greetings to everyone at the CNBC-TV18. There are two sort of parts to the strategy that we have right now. One is we are pushing for increased turnover of the FMCG businesses, which is getting driven largely around the foods vertical at a group level, the non-food FMCG, the Ayurvedic medicines business, and there are a range of other businesses that the company runs, which includes dairy and a couple of similar adjacencies that we have in the businesses. The second part of the strategy is to continue and maintain the profitability in the edible oil business. So the target is not so much on revenue, but on running a profitable growth. So last quarter, we had done in the first half of this fiscal, nearly 28% of our business in Patanjali Food side, which is a listed entity, was about 28% was FMCG. And the the edible oil portion of it was about balance 72%. So the overall estimation is that, the edible oil prices are a big indicator of how much the revenue one will earn. So per unit value per ton is a big number which derives really in terms of the revenue side. We don't look much at it. Our volumes have grown about 28% last year, which is significantly higher than with the way country has grown. We expect this to sort of taper off closer to a regular run rate of between 4 and 6% on the edible oil side. Our foods, FMCG businesses will typically tend to grow at about 15 to 16%. So the net estimation is that Patanjali Food side, the listed entity, again, I'm repeating, should be closer to about 36 to 38,000 crores next year. And at a group level, certainly we should be closer to 45,000 crores plus as we close the year.
Okay. Getting back to the point about profitability, for the edible oil business, what is the outlook that you have for edible oil prices? Because prices have halved. Have you exhausted all your, high-priced inventory? When can you get back to those margins of 3 to 4% for the edible oil business?
So edible oil business, as you know, in last 4 quarters has had an extremely difficult time for most companies, and in fact, even the world at large. I think that is behind us. So this quarter, we should be reasonably better in edible oils in terms of the margin. next quarter, we should be pretty much on a regular run rate. So I think even while the prices have halved, the profit margins have returned because the scale at which it slid has certainly tapered off. And I think the market is also ready to pay, for the value. The demand is back again in a quite a robust way. So my anticipation is that the imports in India will grow at between 3 to 5% this year. Our numbers this quarter, 6% plus is the growth we are expecting on the revenue side. And our margin construct between 2 and 4%, we should be pretty much back to the old ways of margin on the edible oil side.
2 to 4% for the full year or for Q4?
For Q3 and Q4.
Q3, Q4.
Mr. Sana, good morning, sir. I understand you're not been keeping well, so just want to thank you for making the effort and being with us here this morning. Appreciate it. Prashant Desai and Seasons greetings, sir. Just a quick word on the foods business, which I think now is just under 30% of sales. Could you, what's the roadmap? By when do you, that business will keep growing? By when do you reach the 50% share, sir? Because that is what a lot of the street is excited about.
So we had, Prashant, already sort of declared that the roadmap was 5 years. In fact, we have moved way faster on that trajectory. So my estimation is that while we'll maintain the 5 years as a number, that our revenue of edible oil and the FMCG should be 50-50. But broadly, my estimation is that we would be able to surprise the street, probably that this number we could achieve faster. With a lot of sort of work which is going on right now in expanding our foods portfolio, our Nutrela, we're expanding the categories by adding a lot more, sort of making it to an umbrella brand and launching new products in that. And likewise, under the category of biscuits, our growth has been scorching. We're growing at 20% plus year on year. So our estimation overall is that we should be able to achieve this probably in between 3 and 4 years' time, with the addition of new categories and the organic growth that we are seeing in the businesses.
And margins in the food business, Mr. Asthana, what will it be on a steady state basis as you see it?
So a steady state basis, we have maintained that it should be 15 to 16% is what we estimate the margins would do. Because clearly it's a blend of, the categories, which typically some of them are very high margin categories and some of them are not as high. So on a blended basis, on the FMCG, we should be between 15 and 16%.
So, Mr. Asana, we've discussed a lot about the business plans and how you're looking at growing all the verticals. Let's talk about the investments as well then. What is the outlook for the remaining part of 24 and as you're looking at plans for FY25? I believe the cash on books is around 2,000 crores. So just help us understand the investment thought process for the new year.
So we're fairly comfortable on the balance sheet. The cash is closer to 3,500 crores. And, in terms of the need for CapEx, the requirements are fairly minimal. So, other than the regular run rate of maintenance CapEx of between 100 to 150 crores a year, we don't need any large scale investments at this point of time. In year 25-26 and partially 26-27, we would require about 1,500 crores of investments, on which I think our free cash flows are fairly supportive. So I'm not anticipating any fresh requirement of funds really to, fund any of the CapExes that we have targeted right now.
So the targeted CapEx is 1,500 crore in the next 2 years, right?
Year three and year 4. The palm plantation business will come into fruition when we have to start putting the capacities for processing. Otherwise, our CapEx requires, we've got ample capacity to process edible oils in the foods business. There's enough and more requirements. So it's just a routine maintenance CapEx that we spend right now. And the basics in the oil palm.
We are talking about 3 years, 4 years down the line. Are you looking at some point of time demerging the FMCG food business and the oil business, the edible oil business?
So this gets discussed very often and, very clearly the view from the investing community is that, this oil business is not supportive of a large FMCG business. Where the view we have sort of explained repeatedly to investors is that the edible oil business on a margin basis looks low, But on return on equity, it's a very good business. So if once we get back into 3 to 4% margin each time, and are able to rotate the capital, about 5 to 6 times a year, it's a pretty much return on capital of about 15 to 18%, which is a very attractive business to be in. So right now, while the discussion keeps happening at multiple levels, but there is no plan to really remove the edible oil business from the company's portfolio or demerge it.
Okay, all right, Mr. Sana, we'll leave it there. Thank you very much, sir. Great speaking with you here on CNBC TV 18. Good luck as we look into 2024. And once again, thank you for making it today. So that's Patanjali Foods with a quick check on the business. Well, the markets are recovering. We're down just about 35 points. We were down about 60 points on the Nifty. 21,743 is where we are at right now. We'll take a quick commercial break here. Coming up, one of the big winners of 2023, we speak with MCX. Lots to talk about there. The business momentum has been strong. Markets very excited about future prospects. A little later after that, we'll have the management of Make My Trip as we put the focus on holiday season and demand trends there. Stay with us.
CNBC TV18, embarking on a quarter century of excellence.
Co-presented
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. The markets are coming back up very nicely. And today, as always, at 9:40, we speak with the big winner of 2023. And we're putting the focus on MCX. The stock's up, basically it's doubled in 2023, 100% plus. We have Rishi Nathani, Chief Business Officer at MCX, joining us to discuss the future prospects of the company. Rishi, good morning. Great to have you with us here. Thank you very much for your time. Exchanges and capital market intermediaries are all the rage. Be it equities, be it commodities, but more equities and commodities. And the hope is your investors are hoping that, some of the magic of the very high P multiples on the equity side will rub off on the commodity side as well. So with that said, tell us, let's just talk about the business. The new software, which has been implemented now, has seen a few cycles of expiry. How is it holding up? Have you noticed any issues at all? Is everything working pretty smoothly? If you can talk to us about what volumes have been like, just the picture there.
Thank you and good morning, and wishing you all a very happy new year ahead. The technology transition has been very smooth, barring a few isolated issues which we have fixed and are also working in fixing. Our trading is absolutely smooth, and that reflects in the turnover, because go live, when we went live on 16th October with the new technology platform, which is the TCS, with the Deutsche Börse T7, and for the back end with the TCS banks. And the volumes post go live have been in fact higher than what we saw in this current fiscal. So overall, smooth sailing as of now. And I'm sure that going forward, the system will become even more robust and we could add more functionalities and features to it.
So the stabilization has completely happened, and could you quantify? Volumes have been higher.
Yes, so I'll just give you.
But because of the software, or they've just been higher. Seasonality and things like that because of underlying commodities. Sorry.
Yeah. See, software is an enabler. So the volumes, the business is as usual. If the software wasn't working fine, the volumes could have seen a negative impact maybe. But the fact being that everything is smooth, so it is business as usual for us. So if you see in FY 23-24, the overall volume till date has been in futures 20,354 crores, in options 81,220 crores. But if you see the post go live volumes, they have been higher than this. So you have seen 20,094 crores in futures and 87,842 in options. So overall, there has been a growth in turnover pre and post go live.
So, okay, Mr. Nathani, that's obviously on the operational side, how the new software is shaping up. Tell us about tech costs, because from a investor point of view, that has been the big concern, because your tech costs were substantially higher in the second quarter. Now, as the new software settles, and I'm not sure if you're renewing any other contracts of any other nature on software platform technology with 63 moons, just tell us what's the outlook going ahead. First of all, will there be any renewal of any sort of technology contracts with 63 moons? And give us a guidance on the tech costs for the rest of FY24.
So as what I can say is that we have fully migrated to the Deutsche Börse T7 platform with TCS and for the backend with banks. So I do not see any reason why we would renew any other technology contracts. And accordingly, whatever the costs are with TCS are the costs we will have to pay going forward. Whatever we had to pay for the previous technology, we've already paid. So I think it's already behind us.
Okay, so can you just guide on this? Because, I'm just going back and looking at the numbers. In the previous quarter, your software expenses were up 55%. They were at about 135 crores. So purely from a cost standpoint, software, running costs, maintenance costs, etc., what should be the quarterly rate now that you have migrated fully to the TCS platform?
See, again, I will not be able to give you specific numbers, but what I can say is that now costs will stabilize and it will not be any out of normal expenditure on the technology platform.
Okay. You have also applied for approvals and renewals with SEBI for select products. Can you tell us where they stand, which are the products, and when can we hear back from SEBI granting you an approval?
Okay, so see, we always work on various products which we want to launch, and we approach the regulator as and when we are confident that we would want to launch certain products. We also had certain approvals in place, but because there was a gap due to the technology migration, we did not launch it earlier. So we are going for revalidation of certain contracts, and for the others, we will go for approval. So both are being done as and when we see the scope for launching new products. We approach the regulator, and once we get the approvals, we will definitely look at launching them.
Can you tell us which are the products where you're going for revalidation and which are completely new products?
Okay, so completely new products, say, for example, electricity futures. And then also mini contracts, say, which we are wanting to launch in, say, copper and nickel. Then you could also see we are launching a new steel TMT bar contract on 15th of January. So the steel TMT rebar contract is something which was required by the market, and we feel that there's a lot of scope in that. The cotton contract, we would look at bringing certain changes as recommended by the PAC, the Product Advisory Committee. And in the bullion contracts, we have certain approvals which we are looking to revalidate.
Okay, so this is all, this is the whole list of contracts, or where you're basically waiting for the final approval for launch? For the final
so as I said, so as I said, we already had approvals for certain contracts in place, but because there's a time lapse between the approval and we haven't launched it, so we are going for revalidation of certain contracts, and the others we have applied or are in the process of applying for getting approvals.
So 15th of January, you will launch the steel contract. Anything else you will launch in the fourth quarter?
As of now, it's only the steel contract which we've issued the circular for. And as and when we decide to launch, definitely we'll inform the market.
Some of the others could come in Q1 or 25?
See, I cannot give you exact timelines, but all I can say is that now, since the technology transition is behind us, going forward, we will be focusing on getting new products into the market, new contracts into the market, and focusing more on our business growth.
And just a basic question, for all these, when you launch, there will be the futures contract and there'll be the options contract as well?
So there could be futures, there could be, so for contracts, say for example, steel, where you don't have a futures contract, we'll first launch the futures contract, then basis the regulatory norms of minimum timeline and turnover, then we could look at launching options if we see that if we qualify, the contract qualifies for that. And where we already have successful futures, we could look at launching options as well.
Okay. So typically there is a gap between you first launch, there's no contract, you launch the futures contract, and then typically what is the gap between when some of these thresholds are met and you can introduce options contracts as well?
So this is normally a year one would look at, while there's no specific timeline for us to have to launch something, but we already have certain contracts. So for example, in options, we have options in gold, silver, crude, natural gas, and 2 base metal contracts. So there are certain other contracts we could look at launching options going forward.
How many products do you have right now where you're in the process of rolling out options for?
No, so as I said, we continue to study the contracts, and as and when we feel that there is some scope, we will definitely look at launching options.
Okay, so let me just put it down to numbers then. You said option turnover is some 81,000 crores, right? Or actually, it moved up to
87,000.
87,000, right? So,
yes.
Yeah. And you introduced options, what, about a year and a half ago, 2 years? When was the sort of rollout?
No. So the options were launched 5 years back, and for a couple of years, we did not see much traction. It
really picked up, yeah.
Last 3 years, we've seen complete growth in options, and the growth has been phenomenal in the last 3 years. For example, in FY 22-23, our options turnover was 34,000 crores, which is now up to 87. So we've more than doubled in a year.
So when does this near 1 lakh crore in options double? What's the broad number? I'm just asking you because you look at what has happened on the equities, right? 10 years ago, it used to be 90% futures, 10% options. It's exactly the reverse now. 90% options and 10% futures. So the growth there, of course, is much faster. So on the option side, I mean, if you can, and that's the great excitement for investors as well, if that were to happen. Could you lay out a roadmap broadly? What's the thinking?
Yeah, okay. So while I'm no astrologer, but 5 years back, our futures volume was almost 100%. And today, our futures volume is roughly 20%. So we are also getting there, like you said, about the equity markets. And we continue to do our work, and it's up to the market to reward us. So we go out, meet people, do awareness, launch good contracts, and do all that is necessary to make sure that business goes on and grows. And then it is up to the market participants to make sure that we get to 1 lakh, 2 lakh, wherever going in the future, wherever we may go.
Without dipping into the science of astrology, as you said, what's the growth rate you expect for this segment with the existing option contracts and the new ones that you will introduce? Broadly, roughly, in the ballpark, what should we expect?
I can only tell you what we have grown at, and then it's up to you to understand where we could go going forward. So I gave you numbers from FY 22-23, where our total turnover was 57,500 crores, with 23.5 in futures and 34 in options. Currently, we are doing 20.5 in futures and 81 for the full year. I mean, this current fiscal in options. So the growth path is there in front of you.
Rishi, I know you all have a near monopoly, but your competitor NSE is introducing certain products, commodity derivative contracts. How many products does NSE have which directly competes with you? And have they gained any market share? What are their volumes looking like?
Well, competitors are not here now. They came in 2018 when all the exchanges became stock exchanges and all the exchanges were allowed to do various products. And in the last 5 years, I don't see anyone having got much traction. And in fact, our market share has only grown. So I would rather focus on our business and growing that.
Okay. I thought NSE introduced 13 new commodity derivative contracts on 16th of October 2023. And they had already allowed trading in WTI crude and natural gas futures from May of 23.
Yes, but the other exchanges launched other contracts since 2018. So you have all these contracts running, and there are phases when they bring new contracts or whatever. But as I said, our market share is intact. Our volumes are growing. So I'd rather focus on our business, and make sure that grows.
Is there any risk as you see it, Rishi? I mean, it's like, the DRHP, right? Risks, potential risks into the future. Again, I'm asking you to not predict the future. Like for example, I'll tell you, on the equity side, occasionally because option volumes have exploded to such a great degree, and I think we have the highest options volumes in the world on equities. There's this at the margin chatter whether the regulator will step in and whether things like that. I mean, to just curb what's happening there. In commodities, options of course are in their nascency in that sense, right? They've only picked up in the last 2.5 odd years, but that or any other kind of risks that you see?
Yeah, okay. So let me give you a very important differentiation between equity markets and commodity markets, in that then in equity markets, you would have investors, speculators, traders, etc. But in commodity markets, we have much more than that. We have actual end users, producers, consumers, exporters, importers, all these MSMEs, large corporates. So there is a large number of actual users who use the commodity markets to hedge and manage their price risks. So, risks are always there in everything. Without risk, no business is there which is completely risk-free. But having said that, it is all about risk management. It is all about making sure that the commodity markets, which is very nascent, continues to grow. And I believe that the regulator has always been supporting us and will continue to support to make sure that India becomes a price maker rather than a price taker. And that could happen only if the domestic commodity derivative markets grow.
Rishi, we'll leave the conversation here for now. Thank you very much for joining in. That's MCX View, one of the big winners of 2023. All the best for 2024. Well, we are in the middle of the holiday season right now, and 2024 is just a couple of days away. So let's talk about some travel plans then and the trends that we're seeing, the demand environment. Rajesh Magao, the co-founder, group CEO at Make My Trip, is with us on the show. Rajesh, morning. This is Rima here. First question, right? What are the gross bookings looking like, say for this Christmas weekend and even for this October to December quarter, which is generally seasonally strong? What are the numbers?
Yeah. Good morning. Thank you for having me on this lovely foggy morning in Delhi. I don't know if you guys have experienced it or not, but it's quite foggy today morning, and it's actually a great setting for spending time out with the family, etc. as well. So coming back to your question, we've seen very robust holiday quarter trends, as we were sort of expecting it as well. It had a slow start, to be honest, early days in, getting into the quarter, starting in October and November until the World Cup. And as soon as the World Cup got over, it just took off. Because people were sort of maybe distracted with the World Cup games. Of course, we got some surge where the India featured games were happening in those particular cities. But in general, over the weekends, people were just watching more cricket than wanting to step out. After that, it took off, and then from there on, the overall booking trends has been picking, and as they would typically do in the holiday season, in the previous years, as we see. Now, specifically to this long weekend, in fact, from 23rd onwards, we have like full peak sort of travel dates. 23rd, 24th, 25th was a long weekend. We have one more coming up on 30th, 31st, and 1st. And we've seen, sort of record-breaking bookings happening, record-breaking check-ins happening on a single day. On our platform for our hotel business, we would have seen a record single-day checking in of the customers into the hotels, which would be about 20% increase of the previous peak. And that's fantastic. And similar trends sort of for flight bookings and so on. What happens during this time is that every segment, now minus the work segment, which is understandable, the leisure, the pilgrimage, the visiting family and relatives, all segments all come together, and they come together, all of it together at the same time, and that sort of helps in growth in the bookings. So across the board, we've seen bookings happening, and like I said, record-breaking sort of long weekend bookings. Yeah.
No, absolutely, and we see that visibly whenever we're at the airports or whenever we're trying to, you know, find rooms at hotels these days. You said 20% over the previous peak. So, you know, that peak was last year, or was that peak pre-COVID? And how much higher are we versus 2019? I mean, the pre-COVID era.
Yeah. No, that's a good question. So what I was talking about was the previous peak long weekend. So like to like, let's say 3 days long weekend this year itself. And if you start comparing it with over 2019-20, which is pre-pandemic, they're also, you know, on top of, let's say, comparing the peak in 1920, we've seen about 20-25% growth from 1920 peak as well. And specifically for, you know, sort of single day check-in, the data point that I was referring to. On an overall, this has been a growth year, and this has been a growth holiday season quarter as well. If you start comparing it with the 2019-20, both in volume terms as well as in the value terms. In fact, a lot more in the value terms, you know, partly because of inflation, partly because of the price rise, as we all know. And, you know, the other part is that it's also sort of, you know, I actually attribute that to a fundamental habit change where people have started to spend a lot more on experiences. And within the experiences is actually travel. So people have the frequency of travel has gone up. The number of holidays they would typically take in a year have gone up, which is a combination of the short staycation and, you know, specifically in this at this time of the year, it's actually long duration holiday. It's you know, on average, you will have 3 nights to, you know, as many. About 7 nights.
Absolutely, absolutely. Rajesh, you're talking to people who feel it, experience it when we're on our holiday. Even when we're not on our holidays, we're planning the next one or thinking about the next one. So I think, you know, it really applies to all of us here, and the trend has only picked up after COVID. Now, let me ask you the business question. Clearly, the opportunity is huge. The numbers are peaking, and the industry is really booming. But what about the business itself? You know, today there are far more travel operators, aggregators versus, say, you know, 5-6 years ago. Make My Trip was the first, but now, I mean, there are more in the market. So how intense is the competitive landscape? And in terms of market share, in terms of strategy, in terms of growth, you know, what is it that you're witnessing? I know, for instance, there's one point on convenience fee. That became a bit of a differentiator for some of your competitors. But going forward, what can we expect in terms of just competition in the travel space?
Yeah, sure. No, I think it's a great question as well. So, you know, if you really look at it overall, you know, firstly, if I take a step back and talk about the overall sort of business opportunity in the travel space. So the good news there is that the overall pie is growing. And if you look at from a long-term outlook standpoint, you know, on the back of infrastructure expansion happening, airports expansion happening, the demand patterns are changing. The long-term outlook looks absolutely great. And therefore, there is room for sort of more players in the market as well, perhaps. But specifically, when you go deeper into the competition, you know, and that is the way we typically do it, you know, you have to sort of compare and go deeper to see segment by segment and not necessarily look at it holistically, you know, because, you know, from our point of view, if you see Make My Trip offers pretty much every travel use case. So we are like a one-stop shop. But if you start to compare with some of the others, you know, and look at the business numbers, etc., you would see on a particular specific segment, let's say for flights, domestic flights, which probably is the easiest one to sort of get into because of the unidimensional product. But when it comes to, you know, the hotel segment, the packages segment, the homestay segment, you know, a lot more sort of experiential product where it takes a lot to build that business, you know, which we've sort of invested behind. There you will see that the competition is relatively weaker, and you know, we sort of, when we look at the numbers, we end up competing with maybe more global OTAs or the aggregators, as you put it, rather than anyone sort of seriously in the Indian market. But when you look at you know, let's say flight segment, yes, there will be more players in the market, but like I said, the overall opportunity is big. the flight market is growing. I know right now there's a bit of a temporary constraint. Sorry, just to complete the thought, I was just going to say just the temporary supply side constraint that is happening within the domestic market. But 2 quarters down the line, the outlook looks very positive.
Okay. Rajesh, I have 2 questions, but I just want to address the new listing as well. Let's just put that up. Innova CapTab, I think, has come to the market, and the prices should come up to just take a look at it. There you go. Stocks at about 500 rupees. It's about 12% higher as compared to the issue price. So that's the latest in terms of listing. We've had 1, 2, 3 a day in the entirety of this week. So keeping in line with that. Today, of course, there's only 1. Rajesh, rapid fire, 3 questions from me. As a percentage of gross bookings, what is the margin you make?
Yeah, so if you look at our reported results, you would see at an aggregate level, on a blended basis, we do 10% at a gross take rate level, and at about 15% at an adjusted operating profit level.
Okay. No, EBIT margin is a percentage of gross booking?
No, EBIT margin is a percentage of revenue. I would say, so if you look at it from the gross booking, it will be 1.5%.
Okay. Do you think, what should we, so you are the early leader, will the online booking space grow at what, 10%, 15% for the foreseeable future? What is your prognosis?
Yeah, so, if you see, Prashant, historically, and I don't think it's changing, it's also a function of, the internet penetration, which that has been growing. Now the gap has to be bridged between internet penetration and e-commerce penetration, specifically on travel. So if you keep some of those sort of macro factors in mind, what we've seen is that the overall travel market grows about double digits, so 10, 12%. So if you look at some of the industry reports that have come out, they're talking about 10, 12% overall growth for the next 3-4 years of the overall travel market. And our thumb rule for the online market is that you would always see online market growing at a 2x, if not more, of the total travel market.
So around at about 20%, basically.
Yes.
Because market share, and of course within that there'll be market share movements, etc. as well.
That is correct.
Any plans to list? Any plans to list here, Rajesh? You're the original.
Yeah. We don't know.
In the US.
Yeah, no, I know. I mean, see, thankfully the stock in the US market has also recovered nicely and doing quite well. Yeah. And we've been listed there for, over 13 years now.
Yeah.
And it's so far so good. I mean, we've sort of clarified that we don't have immediate plans to, but, it will always be in consideration when we feel the need of sort of raising capital, which we don't feel we are profitable today. We have a very strong balance sheet. So it'll be a function of when you really need, and then at that point in time, would we want to evaluate India market or not? Will be a matter of evaluation at that point in time.
You need it, don't need it, but this is the market to do an IPO. I'm listed here. I was just joking, but it's great conversation, Rajesh, and we hope to do more of these. Appreciate you joining us and providing us with a nice sort of summary of what the industry trends look like across the online sort of travel hotel booking space. Of course, you do much more than that now. So one-stop shop, as you called it. We'll take a quick commercial break here. We'll come back. Markets, of course, there's lots happening. So many new stocks into the mix. Mitesh Thakkar will be with us with some technical trading ideas as well. Stay tuned.
CNBC-TV18, embarking on a quarter century of excellence. CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. So the cut is about 77 to 78 points, about 0.3% lower on the Nifty. Bank Nifty is lagging a little more. Bank Nifty is down about 0.5% thereabouts. So we've got Mitesh joining in to tell us what trades could be like perhaps now. Mitesh, so we are getting that dip. The question is, do you buy now, later? How would you approach it?
Morning, sir. I think, I was looking at 48,050 as the support on the Bank Nifty. And on the Nifty, the corresponding level is closer to about 21,600, 630 zone. So maybe, a bit more lower, we would want to see if there's some support coming in and then take a long position over there. But for the timing, I think, the market does seem like in some kind of a pullback mode. Having said that, the overall bias still hasn't turned negative, so we're still trading with positive ideas on the stock side as well, keeping a long bias unless until we see some kind of breakdown happen. So I think that doesn't look to be a very strong possibility. So we'll maintain a long bias. On the stock side, I have a buy on BHEL. Keep a stop at about levels below 190. Look for a target of around 200 to begin with. And the second stock on my radar is Container Corporation. Recommend buying here with a stop below 846 for targets of 890.
Thank you very much for that. Waiting for a little more of a dip before he goes out and buys the index. 21,600, 630. We'll get to some stocks in the move. Sudarshan is tracking Venus Pipes for us. Sudarshan.
Yes, so Venus Pipes is one of the top gainers today on the back of positive brokerage note. DAM Capital has initiated coverage with a buy call and target is rupees 1,810 per share, which is nearly 30% higher from current market price. As per DAM Capital, Venus Pipes is an emerging contender in the stainless steel pipe sector with hunger for growth, and it is building a niche for itself in high-margin stainless steel pipe space. Large capacity expansion for the company is now behind, and asset sweating will commence. Also, it is going up the value chain, and healthy balance sheet will drive strong 60% earnings CAGR.
Okay, thank you very much for that. 1810 is the target on Venus Pipes. The stock is at 1422. Get into a break. On the other side, we'll be joined by Amit Uplenchwar, the director at Kalpataru Projects International, to talk about their recent order wins.
CNBC TV18, embarking on a quarter century.
Co-powered by
CNBC TV18, embarking on a quarter century of excellence.
Welcome back. Let's put the spotlight on Kalpataru Projects. The company yesterday received new orders worth 3,244 crore rupees. For FY25, the company has a vision of revenue growth of 25,000 crores and an order book of 50,000 crore rupees. Amit Uplenchwar, director at Kalpataru Projects, is with us to talk about the business momentum and, of course, the outlook for the new year. Amit, thank you very much for joining in. Season's greetings to you. So let's just do a breakdown of the order that you announced yesterday, 3,244 crores. I believe it's across buildings and factories, residential buildings, etc. Just run us through the flow, because earlier in December also you announced a couple of orders. So in Q3, what's the inflow and which are the segments where you're getting most of these new orders in?
So, Surabhi, first of all, also to all of you and all your viewers, season's greeting and upcoming New Year wishes in advance. These order bookings for us have been across the board. As you know, we have 6 key segments that we operate in, being, buildings and factories, infrastructure, water, transmission, railways, and oil and gas. And if I tell you up to, year to date, we've got orders in excess of 17,500 crores that we've booked already. And we are sitting on a very comfortable L1 position, which, takes our current order book in excess of 50,000 crores, which is an all-time high for us in terms of order booking. We had said that the order booking target at the beginning of the year should be close to 26,000 crores. And I think by the end of the year, we should be achieving that target as we had promised at the beginning of the year.
So Amit, just the second part of the question then, you're saying order book is standing at a healthy 50,000 crores. Your intake so far this year is about 17,000 crores. Is it uniformly divided across the segments, whether it's, power transmission, building factories?
So, to answer that question, we've got transmission, and so let's start with that, right? Our T&D, which over the last 2 years was seeing subdued activity, has now really stepped up the gas in terms of order awards, announcements, and further bids that are on the horizon, right? So today we are looking at almost 2.5 lakh crores worth of opportunity set in T&D in the next 3 to 4 years before 2031. So T&D has been giving us a large amount of this order book. Close to 35% of our orders are coming from our transmission and distribution business, almost 40%. Our water business has been getting a lot of orders across various schemes of government, be it Jal Jeevan Mission, be it lift irrigation, so on and so forth. Our building and factories division, and as you would have seen in our one of the large orders of our, the orders that we declared today, has been one of the largest projects Kalpataru will be undertaking at 13 million square feet for a private developer in the south. And, so across the board in our urban infrastructure, we've got the letter of award for our first PBM-based underground metro system project for one of the states. And so across urban infra, T&D, water, building factories, we've been getting orders. And so it's not skewed to any one division, but all of them are giving us this order mix as we speak.
So 17,500 by way of order inflows so far. By the year end, FY24, what could be the total quantum of order inflows and your L1 number right now?
So, we are in a good L1 position. Exact numbers, because we still have to close the quarter, Q3. But I think our target was 26,000. And looking at our L1 position and some of the other tenders that yet to be opened, I think we should get to 26,000 crores of overall order book win at the end of the year.
Okay. And what about your FY24 guidance of 25% top line growth and 8 to 8.5% EBITDA margins on track?
So, basis our H1 numbers and the efforts that are going on, I think our 25% revenue growth at the end of the year is something that we are still working very hard towards. And hopefully we should get there at the end of Q4. And EBITDA margin also, we said we will do between 4.5% to 5% of PBT, Rima, and we were very hopeful that we should get to that number also at the end of the year.
Okay, got that. Just a quick word on, good morning, sir, Prashant here. On the 2.5 lakh crore number that you said in the T&D segment, that number is essentially the amount of ordering which will happen in the T&D segment all the way till FY31?
That's correct, because there is a lot of renewable energy, close to 500 megawatts, that has to get connected to the grid. All these projects they're already announced. So you have to have these lines ready for you to evacuate these, the renewable energy. So for 2031, 2.4 trillion rupees is something that has been announced, and we hope to get a share of that as well, being one of the largest players in that space in the country.
No, absolutely. And what is the what's your share typically when these orders come up? I mean, is that the way to look at it, or what had historically?
I think it is a
yeah.
So, Prashant, this depends on at what margins people are bidding, and, so I don't think there is a set pattern. But having said that, for very large, complex project in the transmission and domestic space globally, Kalpataru is one of the top players because we operate across very different segments where the competition is limited to, 4 or 6 players worldwide, whether it's 765 kV or 800 kV. So very large and complex transmission line projects. And so, it's with logic, we should get a part of that opportunity set for us.
Okay. Just one last question. Could you update us to what the current debt levels are at and what are debt reduction plans going forward? There was a note from Novama, the broker, I believe, which said that the sale of some transmission assets along with some restructuring, exit of road, BOT projects could actually help you do that. So if you could help us with what the numbers are, what the plans are?
So I think, debt as a standalone number can skew the picture. Instead, what we've been doing, so whilst we've been steadily reducing our debt over the years. But at the same time, when you're growing at 25% on a revenue basis year on year, you also need to do CapEx. So what we are doing is we are looking at our net working capital days, and to keep that below 100. We are looking at our interest cost on a standalone basis for the core EPC business at close to 2% of our revenue. And this is what we intend to keep at, which is a very healthy balance sheet parameter to see the debt levels of an organization. And we are completely committed to keep our interest rates, in spite of the increased interest rate regime, to be around 2% of revenue and net working capital days of close to 100.
Amit, we'll leave the conversation here for now. Thank you very much for joining in. The stock is up 10% today, buoyed by the recent order wins. And the company is confident about achieving their FY24 guidance of 25% top-line growth and PBT margins of 4 to 4.5%. But as we approach the end of 2023, veteran banker and founder of Kotak Mahindra Bank, Uday Kotak, shared his reflections on the financial sector in a year-end address. Taking to platform X, previously known as Twitter, Kotak laid out a strategic vision for India's financial trajectory, advocating for a comprehensive assessment of the sector to propel the nation towards its objectives. In his address, Kotak emphasized the need to prevent bubbles by employing a multifaceted approach involving policy, regulation, education, and issuance of high-quality financial instruments. He also highlighted the widening gap between the highest marginal tax rates on debt and equity, emphasized the need for reconsideration of the double taxation on dividends, highlighting critical areas requiring immediate attention. He underscored the urgency of reforms in acquisition financing and streamlining of the Insolvency and Bankruptcy Code and the National Company Law Tribunal process to fuel India's aspirations for growth.
All right, let's talk about Tata Group now. Chairman N. Chandrasekaran has asked employees to brace for more disruption and volatility in the new year. In his New Year message to employees, he highlighted that 40 countries are heading to polls in 2024 and complexity in global governance will reach new heights as the world attempts to regulate data privacy, artificial intelligence and carbon emissions. In his New Year message, Chandrasekaran also said that India's future is bright. Amidst all the uncertainty, he identified 3 areas for the group to prioritize: execution, customer satisfaction and technology.
Well, with that, it's a wrap on Bazaar. From the entire team, thank you for watching. Up next is Chartbusters.
CNBC-TV18, embarking on a quarter century of excellence.